I've been tracking global currency flows for over a decade, and what I witnessed last week made my blood run cold. Trump's tariff strategy, the very policy designed to strengthen America, is systematically destroying the dollar's global dominance. And the most terrifying part? Almost nobody in Washington sees it coming. Here's what just happened that should scare every American. Asian companies increased their euro-denominated bond issuance to a staggering 86.4 billion euros in 2025, up 75% from last year. That's not just a number, that's a complete rejection of the dollar system happening in real time. China alone issued 4 billion euros in bonds that attracted over 100 billion euros in bids. When Chinese companies can raise money cheaper in euros than dollars, you know something fundamental has shifted. But let me explain exactly how Trump's tariff plan is backfiring in the most spectacular way possible. When you slap a 25% tariff on Chinese goods, what do you think happens to the payment mechanism? Chinese exporters don't want to get paid in a currency that's being weaponized against them, so they start demanding payment in yuan or euros. European buyers, happy to avoid dollar transaction costs, gladly comply. Every tariff transaction becomes a non-dollar transaction. The numbers are absolutely staggering. Trade between China and the European Union reached 739 billion euros in 2024, with 23% now settled in euros and yuan, up from just 8% 3 years ago. That's a direct result of companies seeking alternatives to dollar-based trade that's constantly under threat of sanctions or tariffs. Trump thinks he's punishing China, but he's actually teaching the world to live without dollars. Let me break down the mechanism because this is crucial to understand. When the US imposes tariffs, it creates what economists call payment friction. Companies suddenly need to navigate complex duty structures, deal with customs delays, and factor in currency volatility from trade tensions. The natural response? Find alternative supply chains and alternative payment methods. This isn't theory. This is exactly what's happening right now. Japanese telecom giant NTT just issued 5.5 billion euros worth of bonds, marking the largest corporate euro issuance from Asia in 2025. Why euros instead of dollars? Because after currency swaps, they can borrow 25% cheaper than in dollar markets. When borrowing costs are 25% lower, the choice is obvious. Every euro bond issued is one less source of dollar demand. Small businesses are getting absolutely crushed by this dynamic. The ADP report shows companies with fewer than 50 employees shed 120,000 jobs in November 2025 alone. These aren't just statistics. These are Main Street businesses that can't absorb the tariff cost like multinational corporations can. Walmart can negotiate with Chinese suppliers and spread costs across millions of transactions. Joe's hardware store cannot. Think about what's happening here. Large corporations have offshore subsidiaries that can structure transactions to minimize tariff exposure. They have Treasury departments that can use financial instruments to hedge currency risks. Small businesses have none of these advantages. They pay full tariffs and eat the costs. The policy that's supposed to protect American workers is destroying American small businesses. Now here's where it gets really interesting from a currency perspective. The Treasury desperately needs to finance nearly $8 trillion in debt refinancing this year. That's $8 trillion in bonds that need buyers. But our tariff policies are systematically reducing the number of entities that want to hold dollars. It's like trying to fill a bucket while simultaneously drilling holes in the bottom. Consider the feedback loop we've created. Tariffs reduce foreign appetite for dollars. Reduced dollar demand weakens the currency. A weaker dollar makes imports more expensive. More expensive imports fuel inflation. Higher inflation forces the Fed to keep rates elevated. Higher rates increase our borrowing costs on that $8 trillion in debt. The very policy meant to strengthen America is creating a debt spiral. Let me give you some historical context here, because this isn't the first time protectionist policies have backfired. In the 1930s, the Smoot-Hawley Tariff Act was supposed to protect American industry. Instead, it triggered a global trade war that deepened the Great Depression. International trade fell by 25%. Unemployment soared. The policy designed to save American jobs destroyed millions of them. but there's a crucial difference between then and now. In the 1930s, there was no alternative reserve currency system. Countries had to work within the existing framework. Today, China has built an entire parallel financial infrastructure. The cross-border interbank payment system processed 170 billion yuan in 2024, equivalent to $24.5 trillion. That's a 43% increase from 2023. They're not trying to reform the dollar system anymore. They're replacing it. Russia provides the perfect case study of how sanctions and tariffs accelerate de-dollarization. After being cut off from SWIFT, Russia didn't collapse. They doubled down on alternative payment systems. Trade between China and Russia reached $240 billion in 2024, with most transactions conducted in yuan and rubles. India started buying Russian oil in rupees. Brazil began accepting yuan for commodity exports. What started as punishment became liberation. These countries realized they could conduct massive trade volumes without touching a single dollar. And once that realization takes hold, there's no going back. Why subject yourself to the whims of American policy when you can build your own system? Now, Treasury Secretary Scott Bessent claims everything is fine. In his recent Face the Nation appearance, he painted a rosy picture of 3% GDP growth and a strong holiday season. But look at what's actually happening beneath the surface. The fiscal year 2025 deficit hit $1.8 trillion during what's supposed to be a boom economy. We're paying over $1 trillion annually just on interest payments. That's more than we spend on defense. Meanwhile, Trump promised that tariff revenue would replace income taxes. Let's do the math. Even optimistic projections show tariffs bringing in maybe $400 billion annually. Individual income tax generates $2.5 trillion. Where's the missing $2.1 trillion coming from? More debt, of course, which means more bonds to sell to a world that's increasingly uninterested in holding them. The irony is thick. The administration talks tough about American economic dominance while literally begging other countries to buy our bonds. Bessent has started using cartoon characters, Franklin the Turtle, to sell Treasury securities. When has the US government ever needed cartoon mascots to sell its debt? That's not strength. That's desperation dressed up as marketing. Asian borrowers are responding predictably. They're diversifying away from dollar-denominated debt at the fastest pace in decades. Indonesia and Hong Kong now issue the majority of their corporate bonds in foreign currencies, but they're choosing euros, yen, and yuan instead of dollars. Each bond issued in alternative currencies reduces global dollar demand. Let me explain why this matters for ordinary Americans. When foreign demand for dollars drops, the currency weakens. A weaker dollar makes everything we import more expensive. We import about 15% of what we consume, from electronics to clothing to food. Higher import prices mean higher inflation at the grocery store, the gas pump, and everywhere else. The feedback loops are already visible. Since the Fed started cutting rates in September 2024, 10-year Treasury yields have actually increased by over 100 basis points. That's completely backwards from historical precedent. In every previous rate-cutting cycle, long-term yields fell when the Fed cut rates. This time, they're rising because global investors demand higher returns to compensate for holding increasingly risky US debt. Bond markets are essentially saying they don't trust America's fiscal trajectory. The yield curve remains inverted, with short-term rates higher than long-term rates. An inverted yield curve has preceded every recession in modern history. It's the bond market's way of saying trouble ahead. But the real game changer is what's happening in the commodity markets. China dominates global supply chains for everything from rare earth minerals to solar panels. When you impose tariffs on Chinese goods, you're not just affecting bilateral trade, you're disrupting entire global production networks. And China's response has been brilliant in its simplicity. Instead of fighting the tariffs directly, China has accelerated its Belt and Road Initiative, creating alternative trade routes that bypass dollar-dominated markets. The Digital Silk Road component focuses specifically on financial infrastructure that doesn't require dollar settlements. Over 40 countries have signed agreements to use China's digital currency for trade settlements. Think about the strategic implications. China controls critical mineral supplies needed for everything from electric vehicle batteries to military equipment. When trade tensions escalate, these supplies become bargaining chips. Countries that want reliable access to Chinese resources increasingly find it easier to trade in yuan rather than risk dollar-based transactions that could be disrupted by American policy changes. The European Union has been watching this dynamic carefully. While they publicly support the transatlantic alliance, European companies are quietly hedging their bets. Euro-yuan trade settlements increased 35% in 2024. The European Central Bank has started conducting bilateral currency swaps with the People's Bank of China, reducing the need for dollar intermediation in EU-China trade. Brazil represents another critical case study. As the largest economy in South America, Brazil's currency choices influence the entire region. After years of being subject to dollar volatility and American monetary policy, Brazil signed a comprehensive currency swap agreement with China. Brazilian companies can now settle trade in reais and yuan, avoiding dollar transaction costs entirely. The timing couldn't be worse for America's fiscal situation. We need to refinance $8 trillion in existing debt while issuing another $2 trillion in new debt this year. That's $10 trillion in total financing needs. But our tariff policies are systematically reducing the pool of willing buyers. It's like trying to sell your house while simultaneously insulting all the potential buyers. Consider what's happening to America's traditional allies. Japan, our largest foreign creditor, has been reducing its Treasury holdings for 9 consecutive months. Their holdings fell to $1.05 trillion in December, down from peaks above $1.3 trillion. They're not selling because they want to hurt America. They're selling because dollar-denominated assets have become riskier investments due to our own policy choices. The United Kingdom, historically our closest financial partner, is watching nervously as the City of London loses ground to Hong Kong and Singapore in Asian financial markets. British banks increasingly find themselves cut out of Asian trade finance deals that are conducted in local currencies. The special relationship means less when the global financial system is fragmenting along currency lines. Let me address the elephant in the room. Some analysts argue that tariffs will eventually force manufacturing back to America, increasing domestic dollar demand. This argument misses crucial points about modern supply chains. Manufacturing isn't just about final assembly. It involves complex networks of suppliers, logistics, and financial services that can't be quickly replicated. Moreover, even if some manufacturing returns to America, the components and raw materials often still come from abroad. A made-in-America electric vehicle still needs lithium from Chile, rare earths from China, and semiconductors from Taiwan. The supply chain remains global, but the payment mechanisms are increasingly non-dollar. The administration's response to these challenges has been more threats and more tariffs. Trump recently threatened 100% tariffs on any BRICS nation that attempts to replace the dollar. But threats only accelerate the very behavior they're trying to prevent. When you tell someone they can't leave, you're essentially admitting you've lost the power to make them want to stay. Putin's response was telling. If the US uses force to compel countries to use the dollar, it will further strengthen the trend of switching to national currencies. In other words, American threats are becoming the best advertisement for dollar alternatives. The technology sector adds another layer of complexity. American tech giants like Apple, Google, and Microsoft generate massive revenues overseas. When trade tensions escalate, foreign governments become more likely to favor domestic tech companies or those from neutral countries. China's restrictions on American tech companies aren't just about national security. They're about reducing economic dependence on a country that increasingly uses economic warfare as a policy tool. This dynamic creates a vicious cycle. Reduced tech exports mean fewer dollars earned overseas. Fewer overseas dollars means less natural demand for the currency. Less currency demand means America needs to offer higher interest rates to attract foreign capital. Higher interest rates increase our debt burden and make our fiscal situation even more precarious. Small business owners across America are feeling these pressures acutely. The National Federation of Independent Business reports that tariff costs are among the top concerns for small manufacturers. Unlike large corporations that can negotiate special arrangements or move production offshore, small businesses have limited options. They pay full tariffs and hope their customers will absorb the costs. But consumers aren't absorbing the costs. They're shifting to substitute products or reducing consumption entirely. This shows up in the economic data as reduced business investment and slower growth in sectors dependent on imported inputs. The very businesses that tariffs are supposed to protect often depend on foreign components to remain competitive. The financial services sector provides another angle on this story. American banks have historically dominated international trade finance because most global trade was conducted in dollars. As trade settlements shift to other currencies, this business naturally migrates to banks in those currency zones. Chinese banks are handling more yuan-denominated trade finance. European banks are capturing more euro business. This isn't just about immediate profits. It's about relationships and information flows that create long-term competitive advantages. When a European bank finances a trade deal between Brazil and China using euros and yuan, they're building connections that could last decades. American banks, increasingly shut out of these arrangements, lose both revenue and influence. Here's what I think happens next, and this is where my years of watching these markets becomes crucial. The current trajectory is unsustainable. America cannot simultaneously run massive deficits, weaponize its currency, and expect the world to enthusiastically finance our spending. Something has to give. The most likely scenario is a gradual erosion of dollar dominance rather than a sudden collapse. Countries will continue diversifying their currency reserves. Trade settlements will increasingly use local currencies. Financial centers outside New York and London will grow in importance. The process will take years, perhaps decades, but it's already well underway. For individual Americans, this transition means higher inflation as the dollar's purchasing power declines globally. It means reduced living standards as import costs rise. It means less influence for American foreign policy as economic leverage diminishes. The very people that protectionist policies are supposed to help will be the ones who suffer most from their unintended consequences. The tragedy is that this outcome is entirely self-inflicted. America's economic dominance wasn't built on tariffs and threats. It was built on innovation, productivity, and the creation of a financial system that others wanted to participate in. We're systematically destroying these advantages in pursuit of short-term political gains. What should Americans do in this environment? I'm personally diversifying away from long-term dollar-denominated assets. I'm looking at real estate, commodities, and assets denominated in other currencies. I'm reducing exposure to U.S. government bonds, especially longer duration securities that are most vulnerable to currency depreciation. But this is just my personal approach. This is not financial advice. Everyone should do their own research and consult with qualified professionals about their specific situation. The larger point is that we're living through a historic transition. The unipolar moment of unchallenged American hegemony is ending. The question isn't whether this transition will happen, but how quickly and how disruptively. Trump's tariff policies, intended to restore American dominance, are actually accelerating the very changes they're meant to prevent. When you see Treasury secretaries using cartoon characters to sell government bonds, when traditional allies are diversifying away from dollars, when small businesses are failing at rates not seen since the pandemic, these aren't signs of strength. These are warning signals that our current path is unsustainable. The dollar's decline won't happen overnight. Reserve currency transitions typically take decades, but the process feeds on itself. Each country that reduces dollar exposure makes it easier for others to follow. Each alternative payment system that proves viable encourages more experimentation. Each threat from Washington pushes more nations toward the exits. Those who recognize these trends early and position themselves accordingly will weather the transition better than those who cling to the belief that American dominance is permanent. History shows that no empire, no currency, no system lasts forever. The only question is whether we'll adapt to changing realities or continue fighting battles we've already lost. The irony of Trump's tariff strategy is that it perfectly illustrates how yesterday's solutions can become tomorrow's problems. In an interconnected world, unilateral economic warfare inevitably backfires. The very policies intended to make America great again may ultimately make America isolated, indebted, and irrelevant in the new multipolar world order that's emerging. The choice is ours. We can continue down this path of economic nationalism and watch the world build systems that exclude us. Or we can acknowledge that true strength comes from being indispensable, not from being feared. The tariff experiment is failing. The question is whether we'll recognize failure in time to change course, or whether we'll double down until the damage becomes irreversible.